Hello, everyone, and thank you for joining us today for HCL Technologies Q2 FY'21 press conference. We hope that you and your families are safe and in good health. I'm Neha Anand, and I would be hosting this conference today. Before we begin the conference, I would like to take you through some key instructions. During today's conference, all attendees would be on listen-only mode. For best results, please select the active speaker video view on the top right of your screens. There will be a Q&A session at the end of the conference. In case you drop out, please rejoin us using the same invite link. If you experience any technical difficulties, you can message us using the Q&A panel. Today, we have with us HCL Technologies President and Chief Executive Officer, Mr. C. Vijaykumar, Chief Financial Officer, Mr. Prateek Agarwal, and Chief Human Resources Officer, Mr. Apparao VV. I would now like to hand over to Mr. C. Vijaykumar. CVK, over to you.
A very good morning to all of you. Hope all of you are doing well and you're safe and healthy. HCL Technologies, we delivered a solid performance in Q2. I'm very happy to report that we delivered a 4.5% sequential constant currency growth and a 6.4% sequential US dollar growth. We delivered an EBIT margin of 21.6%, which is a 22-quarter high. Our stellar performance is broad-based across verticals, across our service lines, across geographies, and across our Mode 1, 2, 3 offerings. Our new bookings remain very robust. It increased 35% compared to the last quarter. We won 15 transformational deals. All of this is listed in our investor release. All of these are net new deals. That's a part of our booking performance. Pipeline grew 20% quarter on quarter, and it's at an all-time high. The brilliant performance is a result of five main factors. One is the intensity of the technology spend being witnessed in the market as companies recalibrate their businesses and the business models for the new normal. The 15 transformational wins are reflective of large-scale modernization and digital transformation initiatives that are underway with our clients as well as the new clients that we've acquired this quarter. All the 15 are, as I said, are listed in our investor release. The second element which contributed to the growth is the stickiness and the confidence of our clients. Many of them continue to give us new programs which help them to survive and thrive in the new world, and us to support them, and that obviously reflects in our revenues. We also have an early lead in the digital foundation business, which is our earlier erstwhile infrastructure offering. This is really the foundational element on which a lot of enterprise transformation programs are being launched. So having an early lead in the digital foundation offering has been a big strength for us in trying to drive the momentum in the market and address the client requirements. A fourth, of course, is our continuous automation focus, right shoring focus, supply chain efficiency, and very strict cost management initiatives. All of them helped us deliver a 5-year high EBIT performance. And fifth, and most importantly, the credit for this brilliant performance goes to the 153,000 HCLites for the tremendous dedication and an excellent execution on all fronts, despite their own personal odds. Our teams executed extraordinarily well to ensure all the transitions happened in a timely manner for all the deals that we booked in the last quarter. We are happy to share that we are implementing the salary increments effective 1st October up to E3 levels, and effective 1st January for E4 and above levels. This is only a 1 quarter shift from the regular increment cycles that we give our employees annually. We're also extremely proud to share with all of you that just yesterday, HCL Technologies has earned the prestigious distinction in the Forbes 4th annual list of the world's best employers 2020, ranking number 30 overall globally and making us the top rated company among the multinationals headquartered in India. I know this has been a challenging year for every company to live up to the employee expectations. So getting ranked as the best employer in 2020 is truly and tremendously humbling experience for all of us in the leadership team. Now, let me provide some color on the segmental, the geography and vertical performance. In terms of the service lines, we report on 3 segments. Our IT and business services grew 4.9% quarter on quarter in constant currency. This is again validating the industry faith in leaders like us to help modernize the digital foundation and accelerate the digital transformation for our clients. If you look at the engineering and R&D services, it delivered again a good 3.6% sequential growth, enabled by a trend of some of the new product engineering work, as well as some new net engagements that we signed up for product sustenance kind of programs. Lastly, the products and platform business grew 3.1% quarter on quarter, which is a reflection of the stability and the traction that we are seeing for some of the products that we have launched in the market over the last 12 months. If you dice the performance in terms of modes, you will see that we've registered an impressive growth of 4.3% in constant currency in the traditional services on a back of an all-round performance spearheaded by the infrastructure business, which is the digital foundation business. Our Mode 2 business grew 6.9% quarter on quarter and more than 15% on a year-on-year basis, driven by digital transformation initiatives. Our Mode 3 business in a seasonally weak quarter continued to grow at 2% plus. Geographically, all the geographies delivered sequential growth. Top of the chart was the ROW, which delivered 9% quarter-on-quarter growth, and followed by Americas at 4.9% and Europe at 2.2%, all sequential constant currency growth. In terms of verticals, our growth was led by life sciences and healthcare vertical, which grew at 8.6% quarter-on-quarter, and followed by the retail CPG vertical, which grew at 8.4% quarter-on-quarter, which is reflecting some of the digital transformation work that is underway in our existing clients, including cloud migration programs, which we are delivering for our clients. I will conclude my commentary by giving an update on our guidance. Last quarter, I had said that we believe the worst may be behind us, and our Q2 numbers validate that assumption. Now, however, we remain watchful of the second wave of the pandemic, but overall, we are very confident of our performance in the H2. We have a robust pipeline. So we believe we will continue to deliver 1.5 to 2.5% on an average in Q2 and Q3. These are sequential quarter-on-quarter growths, and these are purely organic growth numbers. And it does not include the acquisition that we announced, which is still in the process of getting the necessary regulatory approvals. So which is the acquisition impact is not baked in the guidance that we are providing. Also, we are increasing our EBIT guidance. It was 19.5 to 20.5 for the full year. Now we are increasing our EBIT guidance to be between 20 and 20% for the full year. We're also committed to making all the right investments to capture the market in this surge in demand. We want to capture all the opportunities to the extent possible. We are equally committed to take care of our employees, which is why we announced our increments, which is only a 3-quarter lag, which is probably the best in the industry. And we are also confident that our employees will get the similar variable compensation in this difficult year, same as what they would have got in the previous year. So all of this looks good. We've delivered a very good performance. With that high-level commentary, I will hand it over to Pratik to give you more details on the financials.
Good morning, everybody, and trust you are all safe and taking the right precautions. Before I get into a lot of numbers, I just thought I'll point to what I call the oxygen, right? It's the governance that I'm talking about. Governance is one of those things like oxygen we kind of take for granted, but is so very important. Any second that the oxygen goes away, we can imagine. What I'm talking about is in line with the best governance standards. HCL is the only company which came out in the middle of the last quarter and announced that we were going to see significantly higher performance both on the top line and on the bottom line. And we announced 3.5% plus, and we finally delivered 4.5% as CVK already pointed out. And on the margin front also, we said we would be in the range of 20.5 to 21.21, and we finally delivered 21.6%. Also on the governance side, I'm very pleased to announce that ISS, which is Institutional Shareholder Services, has given in the month of October, they have given HCL the highest rating possible, governance rating of 1. This basically indicates the lowest governance risk and is in line with what I talked about in terms of our practices, which were very evident this quarter. Moving into some more numbers, the quarter revenue was at $2,507 million, which basically puts us back in the $10 billion run rate. And that's a 6.4% growth in US dollar terms on a quarter-on-quarter basis, sequentially. And even on a year-on-year basis versus September quarter of last year, we are a growth of 0.8% on a year-on-year basis. And our profitability metrics are doing very well. We are at 26.6% this quarter versus 25.6 last quarter. And EBIT as well is 20.6 versus 20.5% last quarter. So both are showing a handsome increase of 100 and 110 basis points on a sequential basis. And on a year-on-year basis, it's an increase of 322 basis points in the EBITDA percentage. And in terms of the percentage on a year-on-year basis, that's an increase of 165 basis points. The story continues as robust at profit after tax, PAT. The Q2 PAT is at $424 million, which is 16.9% of our revenue for the quarter. And that is increased 9.7% on a quarter-to-quarter basis and 12.7% on a year-on-year basis. The other great news that I have to share from a financials perspective is the DSO, which is basically the working capital that we hold, and that is at a historic low. The DSO in billed terms is at 1 days for this quarter, which is a historic low. And even the unbilled DSO is at 18 days. So a total of 79 days, which is a historic low as far as the industry and HCL is concerned. That has led to a solid cash flow generation for the quarter. OCF, operating cash flow, for the quarter is coming at $643, and free cash flow is at $578 million. And those numbers as a percentage of the income for the quarter is at 152% and 136%, respectively. So you can imagine the company is generating 50% more cash flow compared to what the net income is, because the net income has that much of non-cash elements, which is the depreciation and amortization, some part of the tax, and of course the huge cash flow by a historic low days sales outstanding, DSO. I would also like to point out the last 12 months, the solid cash that has been generated. OCF for the last 12 months is almost at $2.7 billion, 2692 to be precise, $2692 million. And free cash flow is at $2,444 million over the last 12 months. And these numbers as a percentage of the net income of the last 12 months is at a level of 161% OCF and 146% free cash flow FCF. These are numbers which any company should be proud of. As a result of all those cash flows and DSOs, the cash in the company's books as of end of September is at $1.8 billion on a net cash basis, 1.8 to be precise. This has increased over last quarter, which is June quarter. We were at 1.33 billion after paying off the second tranche of the IB out for the 7 products that we acquired from them. And so that was the performance of last quarter. In this quarter, we've added $500 million and now at a $1.83 billion on a net cash basis. Going on to the last metrics, the earnings per share, EPS. The last 12 months EPS now stands at 45 rupees 20 paise, and that is up on a year-on-year basis by 20%. And cash EPS, which we basically point out for the simple reason that cash flows are much higher than the net income itself because of the non-cash elements. The cash EPS is at 60 rupees 30 paise for the last 12 months, and that is up on a year-on-year basis by 36%. So looking at all the great performance in terms of top line, bottom line, and on the cash flows, we have our board has decided to come out with a doubling of the dividend for the quarter and going forward. So far, we have been giving 2 rupees per share per quarter, and we kept on the same 2 rupees on double the number of share after we did the bonus issue last year. Now in this quarter and going forward, our board has decided that we will double the dividend per share to 4 per quarter and maintain it, more importantly, going into the future as well. So that's a kind of a early Diwali gift from our board to the shareholders. I will end with just a quick reminder of the guidance that we've given, which continues to be 1.5 to 2.5% sequential on average for the next 2 quarters. And that is not counting the acquisition revenues, which also we would hope to start getting generated in the last quarter of the year, which would be on top of these numbers. And the annual margin guidance has also been upgraded by 50 basis points So we were at 19.5 to 20.5, and now the renewed guidance for the full year is at 20 to 21%. Thank you for your patient listening, and over to you, Apar, for the HR part of the disclosures.
Thanks, Pratik. Good morning, and thank you all for joining this call. I would like to take a couple of minutes to share again a good news, some of the good news which CVK has shared in his earlier articulation with respect to our employees and HCL. One is we are very proud and happy with the latest recognition from Forbes, where we have secured the 30th position in World's Best Employers 2020, and among we are the first number one among all India headquartered companies to appear in this top 50 ranking. And we sincerely thank all our colleagues for helping us make HCL a better global organization, and our efforts will continue in this direction. Secondly, in recognition of all the efforts of our colleagues, the annual increases have been announced with effect from first quarter, as CVK mentioned. This is just a quarter lag, which is probably best in the industry in terms of compensating people. And these increments are same as what we have given in FY'20. So that should help people understand what is due. Then coming to a very important aspect of the well-being of our employees, we are all in the midst of this pandemic, and HCL as an organization, we are supporting our employees through a lot of policies, new policies and policy changes for flexible working hours, for leave encashment, right, and increasing their bandwidth provisions and costs, and increasing medical coverage. Whatever will have HCL as an organization is increasing that coverage so that people don't have to spend from their pockets in case they need additional money. And we have a very effective tracking mechanism. We touch base with all our employees at least once in a week, and those who are recovering monitor their progress. We have constructed various partnerships with labs and hospitals for expediting the tests and providing beds for our employees and their families. And we have a dedicated helpline which we have enhanced. So this really does over the last few months in terms of very high recoveries of our employees, and we sincerely hope that this will keep our employees healthy till this pandemic is over. Coming to on the work front, we still have around 96% of our people who are working in HCL locations working from home. Approximately 4% of the people are coming to offices. We have prepared our offices for our employees' return in a very gradual and careful manner. We implemented the policies related to deep cleansing, social distancing, and every employee is entitled for a transport, and these are thoroughly sanitized as per WHO norms and Ministry of Home Affairs norms. And when they have to come to the campuses, there are temperature checks, symptoms checks. So these are all the precautions what we are taking so that people don't. The risk is mitigated to a large extent. Now coming to the operational metrics, the net addition we have is around 2798. We have hired 1573 freshers in this quarter. This is lower than what we anticipated because of COVID situation. Lower availability of people is the reason, but we plan to accelerate that in O&D and GFM quarters. We want to be on track with what we have articulated earlier in terms of our fresher induction. The last 12 months attrition stands at 12.16. This is a 247 basis points down quarter on quarter. But actually, if you look at the standalone year-to-date date attrition, that is 9.2%, which is probably the lowest in recent years. Our gender diversity, in spite of the pandemic, remains unchanged. We are at 26.5%. And the number of nationalities people in our organization has is 158. This has increased by 3 nationalities compared to last quarter. And we are running various programs with such a diverse organization. It's important that we enhance our inclusion practices. So we are running various programs to strengthen that. And we also have increased our leadership training programs to suit this new normal. And coming to US localization, we are pretty much unchanged at 67.2%. So we don't see any risk in our localization initiatives there. And our focus on Mode 2 and Mode 3 training, which is the most important for us, how much we are training our employees, upskilling, cross-skilling, multi-skilling our people. And that's at 1.13 million hours this quarter. This has really helped us during these pandemic times, and our internal fulfillment rates have nearly doubled this year compared to what they were in FY'20. We continued our winning streak of HR awards. Notable among them are Brandon Hall and Stevie Awards. These are in the areas of human capital management, inclusion, diversity, and technology adoption. And lastly, we also started digitalization of all HR processes, whether it is talent acquisition, or onboarding, or performance management. And this is all with a view to increase our employee experience. So these are some of the updates from this quarter from Team HR. Thanks once again to all of you for joining, and please stay safe. And over to you, Neha.
Thank you, Appa. We will now be opening the floor for Q&A. I would request Suraj from the HCL Technologies team to moderate the Q&A. Suraj, over to you.
Thank you, Neha. Good morning, ladies and gentlemen. In case you want to ask a question, please click on the raise hand icon on the bottom right of the participant panel, and we will unmute your lines. In case you have joined on phone, please press *3 to raise your hand. Our first question has come on text from Mr. R. Sriram. I am repeating his question. Mode 1 business segment saw impressive recovery on sequential basis. Can you elaborate on the recovery? What is driving the improvement, and by when do you expect this segment to reach year-on-year parity on revenue terms?
Yeah, Sriram, thanks, Tim. So Mode 1 business is a lot of our digital foundation business is a part of Mode 1. And there is definitely a significant amount of work to be done on the digital foundation space, and that's what you're seeing as a growth number. As I mentioned, number of clients are strengthening their digital foundation layer, which is really the foundation for the digital transformation programs. We are almost there, very close to the last year number. Probably in the next couple of quarters, we should definitely reach the previous year March numbers.
Thank you, CVK. The second part of this question is that in the opening remarks, you mentioned that the organization is committed to making right investments. What are the areas of technologies HCL will look to build or strengthen capabilities?
Yeah, I think we've clearly articulated that Mode 2, which is our digital and analytics, cloud native, cybersecurity, IoT, and trying to strengthen our IP portfolio. These are the areas that we would invest in. As you would have noted, we invest close to $250 million in R&D in developing and modernizing a lot of products, a lot of emphasis on automation and AI-led solutions, some of which requires investments. So we will continue to do that. There is in any of the investments that we planned. In fact, we will probably increase a little bit of investments from certain geography perspective. As we had mentioned earlier, we are increasing the emphasis on Germany, France, Australia, Japan, and Canada. So these are geographies where we want to invest and accelerate. And we will continue to explore a few new geographies as well as we move forward. So investment in new technologies, new geographies, and enhancing our IP portfolio are some of the areas of investments, which will continue.
Thank you. Our next question is from the line of Ms. Rukmani Rao from Business Today. Ms. Rukmani, please go ahead.
CVK, hi. Just want to understand, you haven't increased your revenue guidance, but you have when it comes to margin. So how do we read into that in terms of the quality of the deals? Is it more automation that is at play, or are the deals coming at higher margins, or operational efficiencies are leading to this increase in the margin?
Yeah, Rukmani, see, if you look at our bookings, we've booked 15 new transformational deals. All of them are listed in our IR. Many of them are in the new areas, either digital transformation or strengthening the digital foundation for a lot of clients. So these are deals which normally come in at similar margins to what we are delivering. And the 1.5 to 2.5% growth is really based on the information that we have at this point and the overall demand environment. I think even this will result in a healthy year-on-year growth. Earlier, we had projected something like minus 2.3 to minus 0.8. But with this new guidance of 1.5 to 2.5 for Q2 and Q3, so we are likely to show positive growth on a constant currency basis on a year-on-year basis. I hope that clarifies.
Sure. CVK, one more question. What do you think the outcome of the US presidential election will have? Do you see any significant changes? I mean, or the loss in momentum or any such uncertainty kind of play out in the second half?
We do not expect any significant change irrespective of what the outcome of the election is. From a perspective of the digital transformation agenda for the clients will continue to remain a very important focus area for all the C-suite and the boardroom. So that is going to be the primary driver for the growth in the tech services. I do not see that aspect changing in any material way, irrespective of which government comes.
Sure. Thank you.
Thank you. Our next question is from the line of Ms. Poonam Sane. Ms. Poonam, please go ahead.
Yeah. Hello, sir. I just wanted to ask, get more clarity in terms of how do you see the performance, especially in terms of mode 3 as well, and overall, if I'm looking at your business verticals, if you can just throw some light in terms of how do you see the various verticals performing, the demand outlook, and even in terms of the demand outlook coming in from various geographies.
Yeah. So if you look at our Mode 3, for the software product business, this is seasonally a weak quarter. In spite of that, we've delivered a good sequential growth and a very good year-on-year growth. So our product business is giving us a lot of confidence. It is stabilizing. The bookings are very good. In fact, we could prepone some of the bookings of the December quarter into September. Because of the need for some of the products like commerce and a few other solutions which are very important for customers to continue running their business in this pandemic environment. In terms of verticals, we see a pretty strong momentum in life sciences and healthcare, technology, telecom, and financial services. The other verticals, especially manufacturing, while the demand is very good, but our revenues on a year-on-year basis have dropped because of offshoring of a very large client. So that's going to take some time to pick up. So that's the only segment which might lag a little bit, but all others will continue to deliver good growth moving forward. The geographies, again, Europe, the pipeline looks very good, US as well, but I do not see any major difference across the board. I think we see a good momentum in terms of the mix of our pipeline as well as the mix of deals.
Thank you, CVK. Our next question is from the line of Ms. Swati Murthy from Money Control. Swati, please go ahead.
Morning to the team. I just have a couple of questions. One is regarding the salary hikes. Last quarter when we spoke, CVK, you said you are suspending hikes for the year. So what led to the reinstating this salary hike? And also, Mr. Apara, if you can talk about the hiring outlook. You mentioned 1,573 freshers were onboarded. Could you give us some sense of what is the number you're looking at in the coming quarters? And also in terms of lateral, some outlook on that. If you can talk about offshoring and the H1B impact, I understand at 67%, it's not a big deal for you. But if we can give some thought into the wage hikes which are coming in, which are already in effect, the impact it might have on margins, it would be great. Thank you.
Yeah, maybe Appa, why don't you answer the wage hike, and then I will come in and answer the business question.
Yeah. So the wage hike part, I mean, as I mentioned earlier, we are exactly doing the same numbers what we have done, what hike we have given, and the business leaders have given us enough comfort and confidence to give that kind of a hike with that 1 quarter lag. So that's the reason we are going forward. On the freshers front, Swati, though our intake is 1578 this quarter, we are significantly enhancing that in the next 2 quarters. Lot of universities and colleges, we were unable to recruit because they have not finished their final exams. So they are not yet qualified to join us, though we have rolled out offers. So the reason for my confidence in the next 2 quarters is most of the campus freshers, we have already rolled out the offers, and it's a question of they finishing their formalities of final year and joining us. So that is on the freshers part. The third one you asked is on the lateral hiring. We have a significant number of hirings that we need to do, and we are on track. In fact, all of us, we are on top of the situation. We expect a large number of recruitments to happen before December. It is much more than the initial 2 quarters. So that is reflective of the pipeline what CVK was also mentioning. So on all fronts, the recruitment onboarding is going on full steam for us. It's just a question of time to onboard those people and get them into gainful roles.
Yeah, I will respond to the localization question. I mean, as you would know, our localization is one of the highest in the industry, and we were one of the first companies to set up onshore centers and ramp up talent in the onshore centers. Today, 2/3 of our employees are locals and they're not dependent on visa. However, the 1/3 who are dependent on visa, the current regulations definitely requires the wages to be increased significantly when their visas come for renewal. So it will have an impact to our cost. But however, in FY'21, we don't see an impact. There are only 2 quarters more to go, and there'll be a limited impact this year. But it can have some impact in the next year. We will quantify that and share as we plan for the next year.
Just a clarification on the wage hike. So last quarter, after suspending it last quarter, it is because of the confidence you're reinstating it? Because I remember last year's announcement saying we won't be giving hikes. So is it because of the business confidence and the demand coming back?
Yes, absolutely. As I said, One is, of course, we have our growth in Q2 has been a solid performance of percent.
Right.
Initially, we thought we'll be between 1.5 and 2.5. So this growth is obviously giving us confidence for the full year as well. Full year, we will at least be flat or positively growing. So that's again a good thing, and we are doing well on the margins as well. So we are giving hikes with just 1 quarter lag.
Okay, thank you.
Thank you. Our next question is in the Q&A panel from Stuti from PTI, and this is for Appa. The company is looking at accelerating the numbers of fresher hiring. How many freshers will be inducted? Also, what does the number usually stand at?
So we are targeting 12,000 freshers this year. This is significantly higher than last year, where we have done around 8,100. But given the situation, I'm expecting at a conservative level, we will end up somewhere between 10 to 12,000.
Thank you, Appa. Our next question is from the line of Ms. Surbhi Agarwal. Surbhi, please go ahead.
Hi, congratulations on great numbers, everybody. I just had a follow-up question to the hiring question that Stuti asked. So, Appa, can you just explain to me? You said that last quarter, 15,000 people were inducted. These were all freshers. How does it match with the 12,000 number that you are giving for the full year?
No. Last quarter, Surbhi, the freshers inducted were 1,578 last quarter. Right, that is on top of some 1,200 we have done in Q1, which puts the fresher number at 3,000. In the next 2 quarters, we expect to hire at least 7,000 to 9,000 additional freshers. So that's on the freshers. Did I answer you, Surbhi?
15,000 were inducted last quarter, is it, or 1,500?
1,578.
All right, I got it now. Thank you very much. Also, one more question on the salary hikes. Could you just explain, give us the number for what is the quantum of the salary hikes in terms of percentages?
Yeah. So, Surbhi, they vary. The top performer typically will get a very, the top 2 ratings will get almost close to a double-digit hike, whereas the bottom performer might get lower single-digit numbers. It varies based on the stack ranking of people and their what they're rated at. So the average numbers, you are all aware what we have given last year, they stand the same.
Which is what, sir? If you could just explain, reiterate.
So
what is the average number last year?
6% at offshore and 2.5% at onsite is what we have given last year.
Sure. Thank you very much. One last question. CVK in the beginning mentioned about that the profit margins have been at a 22-quarter high. So just wanted to understand that what have been the key factors which are driving this rise in profit margins?
Yeah, a few factors. Of course, see, in the previous quarter, we had the utilization was less, and that is definitely with the pickup in demand, our utilization has increased. That's definitely one. And some of the cost control measures that we put in place last year and some automatic controls that are there because of the current pandemic situation, that's also helping us to kind of keep the costs under control. From a business perspective, if you look at our business, growth in Moto business and the growth in margins in that business is definitely helping. Our engineering and R&D services had a handsome increase in margins compared to the previous quarter. So these are the factors which contributed to the overall increase.
Thank you very much.
Thank you.
Thank you. We have no more questions. Thank you, ladies and gentlemen. Over to you, Neha.
Thank you, Suraj, and thank you everyone for your valuable time and presence today. Please note the recording of this webcast would also be available on the HCL Technologies website. With that, we conclude the press conference. Thank you once again for joining us. Stay safe and take care.